As we head into the week, the market is on a knife's edge. So today, we're going to break down the entire macro picture for you, everything from oil and volatility to stocks and crypto. We'll also map out the 3 key scenarios you need to watch for when the bell rings on Monday.
Here's how we're going to tackle this. We'll start with the big macro drivers, then get a cross-asset snapshot. After that, we'll look at how it all connects, lay out 3 Monday scenarios, and then wrap up with your weekly watch list.
Okay, let's get right into it. We have to start with the one asset that's really shaping everything this week: oil.
Right now, Brent Crude, the international benchmark, is hovering in a really critical range between $114 and $116 a barrel. And you know, this isn't just a number, it's a major signal for the global economy.
And at the same time, you've got West Texas Intermediate, or WTI, which is the U.S. price, trading right around $101. The gap between these two tells its own story about the pressures on global supply and demand.
So here's why that really matters. Any sustained move in Brent above 115 pushes us firmly back into what we call inflation shock territory. Think of it as the first domino. High energy prices feed directly into inflation, and that drives up costs for absolutely everything. In turn, that forces central banks to keep policy tight. Right now, oil is a very heavy anchor on the global economy.
Now, let's switch over to the market's fear gauge, volatility. The VIX index closed out Friday's session at around 31.
A VIX reading above 30 is a big deal. It tells us we are officially in a high volatility environment where investors are bracing for real uncertainty. At this level, the market becomes fragile and demand for protection or hedging is high. That means even minor news could spark some pretty major price swings.
So, with all that stress in the background, let's take a look at how other asset classes are positioned.
What's fascinating right now is the divergence in equities. Despite all this pressure, the stock market has been surprisingly strong. The S&P 500 ETF, SPY, and the NASDAQ 100 ETF, QQQ, are both trading near record highs. This creates a real tension. On one hand, you have strong economic momentum. On the other, the underlying macro stress is building. This leaves stocks particularly vulnerable.
Turning to a traditional safe haven, gold is trading near $44.80 an ounce, and this price reflects a good deal of investor anxiety. This price level shows there's strong demand for safety as investors look for cover from rising inflation and general uncertainty. You know, when you see both gold and oil prices this high, it's a classic signal that the market is in a very defensive, risk-off mood.
Over in the crypto space, Bitcoin is holding steady around $67,000. We can think of Bitcoin as a barometer for liquidity in the market. The fact that it's holding up suggests there's still an appetite for risk, but it's sensitive. You have to keep a close eye on that $65,000 mark. If it breaks below that, it could signal a much wider flight from risky assets.
So how do all these separate pieces, oil, volatility, stocks, crypto, actually fit together? Well, it all comes down to something called the macro transmission chain. It works like this. First, rising oil prices lead to higher inflation expectations. Second, to deal with that inflation, central banks adjust policy, which pushes up bond yields. Third, higher yields and a stronger dollar tighten global liquidity. That's the amount of money flowing through the system. And finally, that level of liquidity determines the appetite for risk assets like stocks and crypto.
In this chain, oil is the critical first link. That's why the price of oil is really the most important chart to watch on Monday. To put it simply, if oil stays high, the whole financial chain tightens. But if oil spikes suddenly, the chain could snap altogether.
With that framework in mind, let's walk through 3 distinct scenarios for the market open on Monday.
We see 3 main paths here. Scenario A, our base case, is what we're calling fragile risk on. This is where oil and volatility remain contained and markets can stabilize. Scenario B is an oil breakout. In this situation, a spike in oil above 120 would send a shock wave through the market, pushing volatility higher and risk assets lower. And finally, Scenario C is our tail risk event, a volatility shock, where a sudden spike in the VIX itself triggers a disorderly sell-off.
All right, let's move to our final section and build this all into a clear watch list for the week ahead.
So, what are the key levels to watch on your screen? For warning signs, keep an eye on Brent Crude breaking above 120 and the VIX surging past 35. In terms of market reaction, a drop in the S&P 500 below 620 would signal serious equity stress, while a move in Bitcoin below 65K would tell us risk appetite is really starting to fade.
So, to pull it all together, the market is defined by 3 conditions heading into the week. First, we have very high energy prices, which are fueling those inflation fears. Second, we have elevated volatility, which tells us the market is nervous and prone to sudden moves.
And third, we're seeing strong demand for safe haven assets, confirming a defensive posture among investors. These macro forces are firmly in the driver's seat.
All of this creates a huge amount of tension in the market. It leaves us with one crucial question for the week ahead. With stocks and crypto holding up for now, but looking increasingly fragile, which link in this macro chain will be the first to break?